It's the largest bank meltdown since the Great Recession more than a decade ago. Silicon Valley Bank, a bank that caters largely to startups and venture capitalists in the tech world, collapsed this week, making it the second biggest bank failure in U.S. history. It's now under the control of the Federal Deposit Insurance Corporation, FDIC, which says depositors will be able to access their money by tomorrow. But standard insurance only protects up to $250,000 per depositor. So for a lot of people, this bank closing came from out of nowhere. So I'm wondering, how much of a factor were rising interest rates in this shutdown?
So rising interest rates were really the factor that caused the bank to have this problem, along with, in some ways, the pandemic, and in some ways, the bank's own management strategy. What basically happened here is in late 2020, the bank began to grow rapidly. They took in lots and lots and lots of deposits, millions of dollars, and then they turn around, and how banks make money is they take our money, the deposits, and they go and invest them. And it's that return that generates their profit. And here, Silicon Valley Bank invested in things like U.S. treasuries. And at the time, interest rates were very low. And so these treasuries these bonds have a very low interest rate. The Fed has raised interest rates aggressively, really as quickly or more quickly than we've ever seen the Fed do it. And that created higher interest rates, and people were saying, we're going to move our money. We want our money somewhere else. And the bank had to keep raising interest rates to attract deposits. So we call this sometimes a net interest match, a net interest income problem. The good news is those underlying bonds that the bank bought are still valuable. They're U.S. treasuries. They're really the safest place the bank could have invested the money. But there are real questions about why the bank didn't anticipate one of the most fundamental financial facts that everybody should know, which is interest rates go up and they go down. You can't bet on them staying low forever. They didn't, they went up, and the bank wasn't prepared for it. And there are some real oversight questions about that.
Now, the thing that I see is that the Fed and the FDIC are signaling hyperinflation, which makes gold and silver even better, because this thing here is trash. They're going to print more and more of this fake money. And that's what the Fed and the FDIC is signaling. We're going to print as much of this as possible to keep the crash from accelerating. But they're the guys who are causing it. Say it again, the problem is the bond market. And my prediction, I called Lehman Brothers years ago, and I think the next bank to go is Credit Suisse. And if that happens, Japan.
Because of its exposure to a lot of this?
Yes, because the bond market is crashing. All those bonds, let's say you're getting paid 5% for a bond and it goes to 10%, the 5% bond crashes. And the bond market is much bigger than the stock market, as we know. Now, and that's why I said the biggest problem, as you know, is the bond market, which is the biggest market in the world. And all the countries of the world are in U.S. bills, T-bills and T-bonds. And we had the BRICS nations coming up, and they hate us, and they might switch to the Chinese gold, yuan. So we're in serious trouble. U.S. dollar is losing its hegemony in the world right now. So because our debt to GDP is over 130, and every time they raise those interest rates, America's taxpayer gets hammered. And my concern is the pensions are in trouble because they're loaded with bonds also. And my generation, the boomers, we're starting to retire. So this is the perfect storm in many ways. So like I said again, I think the Fed and the FDIC signaled they're going to print again, which makes stocks good. But this little silver coin here is still the best. It's 35 bucks, So I reckon anybody can afford $35, and I'm concerned about Credit Suisse.
We're in numerous early stage companies, and I sit in the board of a couple of them. And the first call was get the money out. And some of the resistance was, well, they'll survive this, then they'll remember that we weren't there for them. And I said, you're not hearing me. Get the money out. And there was no resistance after that, because it's not worth betting your company on. And if you take a look at Lehman, it took 14 years for the last person to get their money out, and they weren't all made whole. So you need your operational capital at some place where you can access it. And you just can't risk the fortunes of the company or yourself if you're a founder. So it was no controversial decision whatsoever. Yeah, so we had one founder that immediately tried to wire the capital, and then we're hearing at least a 2-day delay.
From SVB to
another bank.
A larger institution.
Exactly. So he went to the bank, stood on a long line of founders, actually got a cashier's check for a very sizable sum, walked over to another bank, sat there. They wouldn't take it into a business account initially, so had to put it into his personal account, and now is transferring it to the business account. So it's a mess. Look, you don't know really what's going on there because they had credit lines out to, I mean, they were the banker of choice. You've got others like 𝐃𝐈𝐒𝐂𝐋𝐀 Capital, right, that does it. But 𝐃𝐈𝐒𝐂𝐋𝐀 Capital is much, I would say, smarter in how they do it because they take a lot of collateral. It may be personal guarantees, et cetera. But I'm sure there's some risk to others as well. This is, though, ground zero for it.
Well, I think this is a clear reminder of how quickly something like this can happen. I mean, less than overnight, right? It all occurred, and how big and how strong something like a snowball effect is. I talk about the jobs market a lot in the sense of it's like a boulder rolling down a hill. It starts slowly and then it picks up speed and you can't stop it until it gets to the bottom. This seemed like something very similar where, to Steve's point, you know, it started as, oh, everything's going to be okay, it's probably contained, and then very, very quickly it was not contained. So here's what I would say, though, about financials in general. The idea of contagion risk, and you know, are we all going to find out suddenly that big banks and the rest of the banks in America have a ton of exposure to VCs? No, we're not going to find that out. But do all banks have some bonds on their balance sheet that are underwater if they purchase them before 2022? Absolutely. However, this bank did have a concentrated revenue stream, concentrated exposure to certain parts of the market and the economy that have obviously been hit very, very hard. It doesn't, however, prevent sentiment contagion, and I think that's really the biggest question mark.
Look, this wasn't a crazy scheme or fraudulent based, at least not on the face of it. If you're looking at what they did, they just screwed up on risk management here. They were taking a lot of treasuries, which, you know, you would have the full faith of the government. They weren't investing in risky things here. They were investing in treasuries, but again, they screwed up on the duration and didn't realize that their deposit base could disappear so quickly.
You know, the assets of the bank, as was just pointed out, you know, the long-term T-bonds are relatively strong. The customers are some of the best customers anyone could possibly have, you know, for the work that they do in the long-term, you know, profit payoff that you'll see in many of these industries. And so letting them fail would have meant, you know, millions missing their paychecks and layoffs coming because of liability laws that directors would have to follow to lay off people if they don't see a foreseeable paycheck in their future. And by the way, no taxpayer dollars spent. You know, these are bank fees and a new instrument set up to ensure liquidity for any of the other smaller and regional banks. And so I think it's irresponsible to say it's a lazy take to say that, you know, this is a bailout. But fortunately, as I said, I think that the long-term assets here are strong, and hopefully a private acquisition happens in the coming days.